Today on Invest Talk, we discuss the scarcity mindset and how it can hinder your financial progress. Then we dove into the markets today and answered questions on Domino's Pizza, DPZ, CrowdStrike, KRW, and ticker KBR. After that, we ended with a discussion on small caps. Come check it out.
This is Invest Talk, independent thinking, shared success.
Now, my main focus point today concerns this question. Is the scarcity mindset holding you back financially? And this mindset can be helpful in times of economic uncertainty. It can protect you, but it can also hold you back. And so by shifting your mindset and adopting practical strategies, you can build financial resilience and weather any economic storm. And, the recent times marked by the pandemic, by soaring inflation, and economic uncertainty have really driven a lot of people towards adopting a scarcity mindset. This perspective, where resources like money and food and job opportunities seem finite, often results in reactionary behavior, anxiety. And while historically this mindset has helped our ancestors, the hunter-gatherers, survive harsh conditions, today it can lead to unwise financial decisions such as hoarding money out of fear or spending impulsively to preempt shortages. I recall being one of my coworkers in 2020 bought essentially 10 years worth of toilet paper from Costco at the beginning of the pandemic. And it wasn't really 10 years worth, but it's an exaggeration. But I think you get the point. It was a lot of toilet paper. Anyway, while a scarcity mindset can prompt beneficial caution, it can also hinder enjoying life and achieving long-term financial stability. Susan Greenall, a financial counselor, suggests that living in constant fear of losing what you have can prevent you from making sound financial choices, such as investing wisely. Now, this fear might lead you to keep cash in low-yielding accounts or indulge in risky financial ventures like lotteries or speculative investments in cryptocurrencies. And so to counteract these negative effects of a scarcity mindset, it's important to take some proactive steps. So what are they? One, reviewing your financial statements to understand your spending habits. How can you prepare for your financial future or really get a grasp of what your consumption is without reviewing how you're spending your money? Another, set up automatic savings. Certainly keeping money in different accounts outside of your view as if you never had it to spend in the first place can help you save. Maybe you need to be more concerned about how you're presenting yourself professionally, updating your resume, right? To help with the anxiety of when you need to have an unforeseen job change, be it that you don't think that your current income is meeting your expenses, or perhaps the company you're in is downsizing. So all these things are proactive steps you can do to help prepare for these unforeseen circumstances. One of those things that I don't think you need to do, honestly, obsessing over stock prices. When you obsess over stock prices, we just talked about it. They day-to-day are random walks. You are doing something that puts you in the mindset of a gambler and not an investor. And when you're in that mindset, you're more likely to fall for some of these get-rich-quick schemes. And all these things can be detrimental. So taking the time to understand your true needs and setting clear financial goals can help quiet the external noise and focus on what truly matters for your financial health and your financial future. Now, in the next Invest Talk, we'll look into the story behind this headline: Retirement Plan Changes, what the IRS update means for you. That's Monday, but for now, I'm Luke Guerrero, and I'm ready to take your calls at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the Invest Talk podcast.
Let's talk about the market today. U.S. stocks ended lower. The Dow down almost 1%. S&P down about 70 basis points. Small caps down once again. The equal weight S&P actually performed roughly in line with the more well-known large cap index. Underperformers included, looks like credit cards didn't do too well. Cybersecurity, I think we all know about that. Outperformers including interactive media, medtech, pharma did well today. Gold down 2.3%. Oil settled down almost 3.5%, ending the week lower. Cybersecurity down because there was a massive global IT outage from CrowdStrike. That company certainly suffered. Their stock price suffered and brought a lot of industries to a halt. That's something that we will talk about a little later on. Big story for the better part of the week has revolved around the meaningful rotation driven by disinflation, soft landing narratives, the Fed pivot, and potentially rate cuts on the horizon. Looks like no Fed speak next week with the blackout period leading into the July 31st FOMC decision. It's expected that rates will not be cut, though they may give some further guidance heading into the rest of the year. Bullish talking points for the week. Well, a lot of that FOMO related to those things I mentioned. Fed pivot, soft inflation, which saw the fourth largest inflow to U.S. equities on record in the week, the 5 days ending July 17th. Small caps attracted almost $10 billion, the second largest weekly inflow ever on the back of that rotation. The soft landing macro theme really supported by better than expected June retail sales and dovish takeaways from the latest comments from the Federal Reserve Chair, Jerome Powell. On the bear side, the rotation, out of momentum in tech weighed heavily on that large cap S&P 500 index, really providing more credence into the scrutiny on concentration. Mag 7 names dragging the whole index down. That drag on semis exacerbated by the U.S. considering more strict trade restrictions as part of its chip crackdown on China, as well as the Republican nominee's comments on Taiwan and what security assurances might be happening in a second Trump administration. Looking at it next week, PMIs are on Wednesday, and PCE, the Fed's preferred inflation metric, is happening on, or rather being released on Friday.
Hi, Justin and Luke. I was interested in buying Fastenal Company, ticker symbol FAST, for a long-term hold, something just to buy and put away and not think about. I'd like to get your opinion on it. Thank you.
So Fastenal Company, ticker FAST, is a wholesale distributor of fasteners and tools. They also have hardware stores. And the first thing you got to know about this company is they're incredibly well run. Their growth is phenomenal. Certainly over the past 5 years, they've grown 8% on an annualized basis, and that's been pretty spread out over the past 5 years as well. Their cash flow has been improving for quite some time. Their margins are incredibly stable. I think their net profit margin is around 16% year over year. It's dropping slightly to 15.5% projected this year, but regardless, it's a well-run business. It's very stable. It has a $39 billion market cap and only get this $500 million of debt. So there is really not much leverage at all employed in this company. Now, frankly, businesses that operate on leverage, we don't like too much debt, but operating on debt allows you to get higher returns mathematically. You just get higher returns for the amount of equity you're putting in business. So this company certainly has room to lever up a little bit if they want to. That's definitely a good sign of this company. Now, they've been buying back shares since 2020. They issued some shares, it looks like, in the past year, but not too many shares. They pay a dividend, 2.27%, and they've been, pretty strong for this industry, up 18% over the past year. Now, all this is good. All this is great. All this is fantastic. But the problem here is that, with that all being said, they're trading at a 33 times forward-looking price to earnings. And that is very, very high, especially for a company in this industry. It's trading 11 times forward-looking price book, 30 times price to cash flow. And why is that? Well, a lot of that could be under the consideration that they're not levered at all and that they could lever up, they could expand. It could be that the growth is incredibly consistent. But regardless, for me, for a wholesale distributor and hardware store trading at tech earning multiples, I would have to pass for now. Again, it's a very well-run business. I would keep it on my watch list. I think in the long term, it'll do well. I just think it's pretty expensive for now. Thanks for the call. We're getting live calls early. It looks like we have John from St. Louis who has a question on DPZ. Do you own it or are you looking to buy it?
Looking to buy it.
Cool. Well, DPZ, Domino's Pizza, is... there was a joke about Domino's Pizza being a tech company. And the reason why is when they reorganized their recipe, the other thing they did underneath the table was completely rework how they took deliveries. And if you listened a couple of days ago, I was talking about Starbucks, I think on Tuesday, and how one of the big problems with Starbucks is they haven't figured out how to take people's orders. They have so much volume of orders from the early morning to the early afternoon that people look on there and see the wait times and they just walk away. And that's something that Domino's was actually able to figure out really well in terms of how they bring in volume, keep their customers aware, get the orders to stores, and get all that delivered out. They did an excellent job doing that. Now, with that being said, they're a $14 billion market cap company, only $5 billion worth of debt. Their cash flow has been consistently improving over the past 5 years. Profitability looks pretty solid. Now, within the last 3 months, however, they're down about 15%. Why is that? Offhand, I don't know if there's anything specific to this company, though. A lot of Americans are tampering back on their spending, especially on delivery, takeout, those things that have additional costs outside of just going out to eat. With that being said, however, I think this company is incredibly well run, and I think that their growth strategy and their growth in general, and taking the largest criticism against them in their early 2010s and fixing that, completely changing their brand and what they invest in as a business is certainly something that I like as an investor. But we're also talking about a pizza company that's trading at 23 times its cash flow. So I still think it has a little room to fall down. Its relative strength has been falling for about 3 months now. So I don't think it's at quite at a buy point yet. So I would keep it on my watch list, but it looks like it's broken some support. It's probably in another price discovery phase. So I'd hang on to that for quite some time. Keep it in the back pocket, but I do like the business. Thanks for the call.
Thank you.
Now we're going to do a short break, and on the other side, we'll take your questions on the Invest Talk Anytime listener line. We already got through one. Let's do another. 888-99-CHART.
Love today's Invest Talk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
Now, we got a lot of ground to cover over the next 40 minutes or so. So here's some of what I have planned for you, time permitting. We'll also be talking about that tech outage that I briefly mentioned from CrowdStrike and what that tells us about if we should really shift wholesale to let our entire lives be run on the cloud. We'll also talk about that small cap resurgence. What's driving that? What does that tell us as investors moving forward? And lastly, given the rise of talk around AI, it's important to take a look at America's unreliable power grid. So we'll dig into that should we have time at the end of the show. We also have some voice bank questions ready to play, including one on traveling investors and one on KBR, as well as some questions that came into the comments section of our Invest Talk YouTube channel. But let's get right to it and play another caller question now.
Hello, Justin and Luke. This is Paulo from Gaithersburg. I'm traveling overseas right now. I'm in Southeast Asia, and it is a place for a lot of innovation here. Do you have any recommendation you would give a stock investor what to look out for when you're traveling overseas? Is that something you guys do specifically? Is there like something you're on the lookout as investors? And I'm curious about the answer, and I'm looking forward to listening to it on the show. And I wish you all a good one. Thank you. Bye-bye.
Well, Paolo, that's an interesting question. And I would say, first and foremost, unplug, relax, enjoy your time. Traveling. Certainly, if you're fortunate enough to be traveling across the country, across the world, I hope that you use that time to relax a little bit and unwind. Now, that being said, there's certainly some things that you can take a look at. It's difficult to get the, let's say, business dynamics of what's going on just by traveling, especially because maybe you're doing touristy things. Now, if you're on business, that could certainly provide some foresight into the inner workings of companies in another country. But generally speaking, I think one of the most powerful things you can look at as a traveling investor, as you said, is what are the trends? What do you see people spending their money on? And I don't mean the other tourists within the country. I mean, what clothing brands do you see on every street corner, right? What restaurants do you see on every street corner? The most powerful part of an economy is the consumer within that country and their ability to spend on things. And so you might glean some interesting information about American companies. You know, you might glean some interesting information about how the consumers are spending on American products or maybe on European products. You may find brands that are smaller companies that you don't see in the US yet. Go in, talk to people, right? I think that's the most powerful thing about traveling, about experiencing other cultures, is talking to people. And you don't go in and you say, you know, I'm from this place and tell me what you're buying. But start a conversation. I think the cultural exchange that happens in these types of situations can be very meaningful, not just as investors, but as people in general. Very interesting question. Thank you for the call. Now, I'm not sure if we can fit in another question. Unfortunately, we can't. So I'm going to briefly mention the newest KPP Premium newsletter, which will be distributed tomorrow. This week in the KPP Insights section, we discuss small caps, something we're going to talk about today on the show. Why is it that small caps historically, and I don't mean over the past year, tend to outperform large caps? What drives those things? What are the risks? In the stock ideas section, we mentioned a retail company as well as a car company. And in the portfolio management section, we touched on how to become a successful stock trader. Now, if you're interested in learning more, visit us at investtalk.com and subscribe. The newsletter will come to your inbox on Saturday mornings. Let's go to Tim from Temecula, who has a question about CrowdStrike. I assume you're looking to buy it after the drop-off today?
Actually, I own it, but I'm just wondering, is there any hope it's going to come back? It's down 11%. I mean,
it is down 11%,
really?
and I want to preface this by saying daily price movements are what Malkiel called a random walk. Right. It's generally difficult to predict daily price movements. And that's because there's a lot of things going on there. Now, the reason why it's down 11% is because a utter failure of the company.
Oh, yeah, I know.
You certainly know why. Interestingly enough, I don't know if it's true, but I actually read that Southwest might be the only airline that didn't suffer because they're still using like a version of Windows from the 90s. But regardless, they did an update. It caused problems for just about everybody. And so the stock's down 11% today. It might get a bounce tomorrow. You know, typically when you have things like this, sometimes you have deep follow through, sometimes you have bounce. I don't know what's going to happen to the price tomorrow. But looking at the company as it is, because we've had people call, actually, so someone asked about buying it today. And my response is it's trading at almost 70 times its cash flow. And this isn't a company that I think has a generally deep, wide economic moat. You know, I think that inertia is a very powerful thing in technology. And so you tend to stay with one provider. But when you're crippling businesses like this, you know, it certainly is a reason to, once your contract is up, look towards another security provider. With that being said, right. I don't know what's going to happen, tomorrow, the next day. It's been trading at ridiculous multiples for quite some time. Its average price to cash flow multiple is 99 over the past 5 years. That is wild. And so I've thought it was overvalued for quite some time, but just because I think it's overvalued doesn't mean that the fundamentals are going to come back down to reality, in the short term. It could go back up. I don't know. But I think as a long-term investment, it seems to me like that is wildly expensive for a company that doesn't seem to have that deep of an economic moat. Yeah. Thanks for the call.
Well, I committed the sin of buying it and forgetting why I bought it. So Steve always told us, write it down. But anyway, I appreciate it.
Yeah, well, write it down. Yeah, it'll help. But maybe don't keep it, in a cloud that is protected by CrowdStrike, because maybe it'll go down when you need to look into it. Anyway, Thanks for the call.
Yeah. Enjoyed our insights on Invest Talk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
Hey, Justin and Luke, this is Josh from the UK. I had a quick question about my employee stock purchase program. I'm employed by KBR, Kellogg, Brown & Root. I have a 6% discount with this employee stock purchase program, and I've been in it for about 2 years, and I'm not overweight in it according to my whole portfolio, but KBR stock has kind of gone up in price for the last 2 years. And I'm just wondering if right now it's kind of too expensive and if maybe I should opt out for a year, or kind of just to get your opinion on what you think about this stock and kind of where it's headed in the next few years. I appreciate any input. Thanks.
Yeah, so KBR Inc. is a global engineering procurement construction company, has a lot of government contracts, has a lot of private contracts as well. 77% of its business looks like is government solutions. And so they've had some pretty strong revenue growth due to growth within that sector specifically. Now, the company reported 7% year over year increase in revenue in Q1 2024. A lot of that growth still, like I said, driven by that government sector. And so they have good free cash flow growth potential. Their cash flow has been kind of all over the place, but growing consistently over the past 5 years. Their profitability, it looks like, has been adjusted for external items relatively stable, or rather that's one-time occurring items relatively stable. And so over the past 5 years, as a company, the revenue growth has been 7%. They don't have a lot of debt, $2 billion on a $9 billion market cap company. And all of these things looks to me like the company's headed in a generally good direction. They've been buying back shares. They've had earnings upgrades. Their stock price has been pretty good over the past year, up 22% year to date. And so the question is then, do I think it's overvalued? I think it's probably fairly valued for the growth you're getting. Looks like they're trading slightly above their average price to earnings. And so what you're looking at here is you're getting a discount if you invest in this stock purchase plan. And so in a similar way that I wouldn't advise throwing away free money with your 401k match, I would say here, given that the company is not heinously overvalued, given that the business is solid, they're not operating on too much debt, and the growth potential seems to be pretty solid as well, I don't see any reason to tamper down on purchases over the next year within this. And certainly if you have a situation where your weight's getting high, then trim some of the shares that you already were purchased through that purchase plan before. Keep it a reasonable portion of your portfolio. I think when you're thinking about companies getting, in a stock purchase plan for your company, I would think of it as different from a normal company. If you have a tolerance band about how much weight you want to have in any individual stock in your portfolio, I would make that even smaller for your company stock. Why? Because your income is also tied to this. So you actually have more exposure. So if you're going to have a random company at 5%, you certainly want a company that you're also having your income from on a day-to-day basis at a lower tolerance than 5%, in my opinion. But I don't see any reason to tamper back now, especially with that discount. Thanks for the call. Now on Fridays, we generally make time to fit in a quick rundown of key benchmark numbers. So let me hit you with that list right now. The 2-year Treasury yield was at 4.515%. For perspective, last week it was at 4.451. 36 weeks back, it was 505. And more than 2 years ago, 134 weeks ago, it was 0.64%. The 10-year Treasury yield was 4.242% today. Last week, it was 4.177. 36 weeks back, it was 4.63. And 130 weeks ago, that number was 1.762. Gold was priced at $2,400 an ounce. Last week, it was priced at $2,413. 36 weeks back, it was at $1,935. And 124 weeks ago, it was $1,806. Silver today was priced at $29.21 per ounce. Last week, it was $30.82. 23 weeks ago, it was at $22.80, and 117 weeks ago, it was $23.94. Oil was selling for $80.13 per barrel. Last week, that number was $82.22. 32 weeks ago, it was at $74.30, and 132 weeks ago, it was at $66.62. The national average for a gallon of regular gasoline is $3.50 per gallon, a 3-cent decrease over last week. I'll take any cent I can get. 59 weeks ago, it was at $3.56. 107 weeks ago, that was $4.25. And 127 weeks ago, that was $3.57. In California, it was averaging $4.70 per gallon, down 6 cents from last week. 38 weeks ago, it was $5.32. 114 weeks ago, it was at $5.87. I do not miss those days. For comparison, in Iowa today, gas was averaging $3.27 per gallon. That is $1.43 less per gallon than gas in California. Now, we already talked about it a little bit today, but let's talk about it a little bit more. A massive global tech outage caused significant disruptions across various sectors, from airlines grounding flights to banks experiencing service interruptions. Now, this incident, as we've already talked about, was triggered by a software update from cybersecurity firm CrowdStrike, and it underscored the vulnerabilities associated with our increasing reliance on digital technologies. The outage affected key services worldwide, highlighting the interconnected nature of modern infrastructure and the potential for widespread consequences for a single point failure that has so much influence on the global network. Now, the software issue itself, which is linked to a content update for Windows hosts, affected customers of Microsoft, prompting both companies to work swiftly on a resolution. By late Friday, services began to recover a little bit, though the full recovery for some systems might take longer, certainly through the weekend. Now, the financial repercussions were immediate for CrowdStrike, certainly, down over 11% today. And this event not only spotlighted the risks of centralizing critical functions with major tech companies, but also sparked really discussion about the robustness of the world's internet infrastructure. Experts are debating the implications of such a dependency, especially as it relates to cybersecurity and operational resilience. And so in a time where AI is the dominant theme, I think this is an important conversation to have. How fragile is the infrastructure over which most of us operate? Think about how much logistics matters in this world. Not just for travelers who are trying to take airplanes, get from point A to point B. Now think about businesses. Business travel isn't as big as it used to be, but so many people today don't take direct flights, connecting flights. Missing one flight, having some flights grounded, affects a lot of people for a longer period of time. They have to play catch up now. They have to be flown out the next day. There's a lot of logistics issues for personal travel. Think about business movements. How much of the world is controlled by shipping? How are those shipping schedules kept? How are those shipping logs kept? And so fortunately, this was an issue that seemingly for most uses was easy to rectify. But the point that it brings up is that even an unintentional single point failure can have devastating consequences, not just for the company in terms of how its stock is moving, but for a wide array of industries. And so this outage serves as a stark reminder of the fragility of our digital ecosystem, and more than anything, given where it appears that ecosystem is moving, the need for enhanced protective measures. Now let's swing back to the InvestTalk voice bank and answer another caller question now.
Hi, I'm calling today about some silver companies. I already own some large cap like green and precious metals, but I was calling today about some smaller cap silver companies to play the silver trade. If you could please take a look at two for me, EXK, Endeavour, Silver, and SILD, Silvercrest. Hopefully you can take a quick look at either of them. Let me know if you think any of them are a good buy right now, and just a quick look at the numbers. That would be much appreciated. Thank you very much. Love the podcast.
So EXK, let's start with this one, is a silver company. It's a mineral company. It evaluates, acquires, explores, and develops precious metals in primarily looks like China and Chile. Let's see what that revenue breakdown is here. Yeah, all of their businesses is primarily from Mexico and Chile, headquartered in Vancouver. And what you see in terms of its revenue is pretty well paced to silver's growth. So talking about silver relative to gold, right? Silver is less of a hedge against inflation, thought of rather, and more of a input metal in global production. So silver's price tends to be more correlated to global demand in production. And industrial production, rather. And so taking a look at this company, it looks like it's trading at a relatively fine valuation compared to its averages, 19 times forward-looking earnings. Nothing too crazy there. Its margins have been expanding pretty consistently since 2020, when it was making about 88% on its net margin. That grew to 8.4 in 2021, and now it's set to be at 7.1%. But again, these margins are going to fluctuate with the price of silver, and that makes sense to me there. Let's take a look at SILV. Now, SILV, Silvergate Capital Corp, their exposure is really not showing up. So that's not very helpful at all for me. So let's just talk about the first one instead. That one was EXK. Unfortunately, we won't be able to do both. And so I mentioned, some of the issues here that I don't see that you can see with a lot of these mining companies is operating in countries that are prone to destabilization. And certainly this is not operating in the US, not operating in a generally first world country, but you don't seem to have those problems in Mexico and Chile. And so, this is like I said before, a company that is just going to fluctuate with the price of silver because it's like any commodity company. Its price and its revenue and its margins are completely predicated upon the underlying commodity itself. The benefits of investing in a miner rather than investing in the commodity is that they tend to be able to vary costs. And so you have a less volatile investment experience. But like I said, it's going to be predicated upon the commodity itself. I don't see any issues here. I don't see any glaring issues here. I think it's not in particularly destable countries where it's operating. It looks like it's had some pretty good revenue growth over the past 5 years. Margins improving. All looks pretty good to me at a pretty fair price. So I have no problems with EXK. Now, I hope you've been telling your friends and family about our audio podcast being on YouTube. And if you are interested in getting a question to us, that is another place where you can leave it. So we got a question for you today on IBP. It says, thoughts on IBP stock? Very straightforward question, I would say. And so let's pull up IBP, which is installed building products. And so they install installation into residential and commercial properties. And so what you would expect is when properties are being built or when properties are being refurbished and when the property market is doing well, this company would do well as well. And so recent analyst upgrades for this company caused the price to, I think, gap up a little bit earlier in the week, maybe to the tune of, let's take a look, maybe 5 to 6% or so. And so anytime you have analyst upgrades, consensus analyst upgrades, you're certainly going to have increased trading volume and trading activity associated around the company. So is it justified? Well, their cash flow has been steadily improving. Their profitability looks a lot better. Their market cap is only $6 billion, and they have less than $1 billion in debt, about half a billion dollars if you take into consideration the cash that they're sitting on. And you have some pretty consistent growth, 15% year over year growth annualized, going back to 2018 where they had revenue of $1.3 billion. Now it's projected to be $3 billion this year. So that certainly looks good to me there. Their margins, like I said, have been steadily improving as well, from 4.1% net margin to about 8.8% last year, improving year over year over year. So with that revenue, they're also reducing costs. That's a good thing. Projected to have a 10% margin this year. Now, how does it look in terms of relative price? It's honestly pretty expensive. It's on the upper end of their 5-year range, 10.2 times price to book, almost 20 times price to cash flow. And so for me, I think that what you have seen in the past couple days, given the gap up in earnings upgrades, is flows to a company that is being covered more now. And so you see it's down about 1.28% today. That is certainly more than the small cap index was down. This is kind of like a larger small cap, lower mid cap. So underperformed the index a little bit today. Given the news associated with the earnings upgrades in the past week, I would likely stay away from it for a couple weeks. Another reason being that earnings are announced August 1st. So generally speaking, I like to give the advice to stay away from companies surrounding earnings periods, certainly within 1 to 2 weeks of earnings announcements, because there's a lot of volatility within the stock price. There's a lot of people taking either side, and it could certainly move for you, but it could also move against you. So once that earnings momentum kind of slows down, once the market digests that information and prices that in, that's when I would generally think about investing in a company. Thanks for the call, or rather the comment. Thanks for watching. Looks like we got another one. This one on WMS. Do I think WMS is a good company? WMS is not waste management services. I know that, certainly. WMS is advanced drainage. So it's up a lot over the 1 year period, up 38% over the 1 year period. Yeah, 38.11%. And that's because it beat earnings last quarter and projected to grow pretty consistently, or rather grow pretty well this quarter. The reason why is because there's been increased demand due to climate events and pressure to reduce nitrogen output. And so taking a look at this company, the growth is certainly evident. 15% year over year for the past 5 years. Pretty solid. Their margins, also pretty solid. Their net margin, get this, was under 10% in March of 2019. They have steadily grown that to be 25.2% last year, projected to be 26% this year. Oh, I'm sorry, 17% last year, 17% this year. And so that's pretty great. Now, on a relative valuation perspective, it looks a little expensive to me. 19 times on its cash flow, which is above its 5-year average. I think that given the demand for these types of products, the thermoplastic corrugated pipe, which is kind of essential within infrastructure, given climate dynamics, I think this is a good company. They've been performing really well. They have pretty minimal debt, but I still think at 24 times price to earnings, kind of expensive. I'd keep it on my watch list. This is Invest Talk, and I'm Luke Guerrero, and the weekend is almost here. Before we head off to the weekend, I would love to hear from you. So our work continues after this break. Get your questions in now at 888-99-CHART.
We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART.
Good morning, Justin and Luke. Calling about SPH, Suburban Propane Partners. Been on my watch list for quite a while and made a little run this last week. So did a lot of things, but kind of looking at that and wanting to know what your guys' valuation on that one is, and maybe if we're kind of at a good buy point here to get in, or what your guys' thoughts are on that one. Appreciate all you guys do and keep up the good work. Thanks.
So Suburban Propane Partners, get this, is a propane company. Pretty straightforward. And much of their business still relies upon residential propane distribution. And so it had a little bit of a run-up. And that run-up was pretty correlated to a lot of small caps. It's a small cap company, $1.2 billion. Their cash flow has been kind of falling and their margins have been shrinking. And the reason why their margins have been shrinking is because they have a lot of debt. They are uncharacteristically levered, $1.3 billion on a $1.2 billion company. Now they're only at a 2 times interest coverage ratio. But that still signifies that there's not a lot of room for error there in affording the debts that they've taken on and the leverage they've taken on. And so you combine that for me with less than 2% annualized growth over the past 5 years. I don't know. I think that for me, for a company that strategy has primarily been about buying other businesses and acquisitions and expanding that way, expanding geographically, that's a lot of leverage to take on. And so at a certain point, they're going to have to start paying down their debt, because right now there's not a lot of room for error for them. And so with recent earnings downgrades and with the run up as small caps have run up, I think I got to pass. I think it, and the consensus, by the way, the consensus target price right now is about 16.5 from 3 different brokers that cover it. And it's trading about 1873. I think it's run up too much. I think it'll come back down. I think the realities of its debt are going to probably catch up to it at some point. Now, before we head off into the weekend, I think this is a great segue, actually. Let's talk about small caps, primarily the resurgence of small caps in the US market, because it's been pretty notable. Historically, underperforming this year, or at least compared to their large cap counterparts. The Russell 2000 index has seen a significant rally, surging 9% and reaching their highest level since early 2022. Now, this shift contrasts pretty sharply with the performance of its large cap counterparts, who have slightly declined over the past couple days. And this sudden outperformance has really sparked a discussion amongst analysts about the potential for they love naming things, the small cap summer, or really just a broader great rotation from large into small caps. Now, this movement is particularly intriguing given the context. Small cap stocks have lagged behind amid high expectations and false starts, such as the rally before Christmas that fizzled out due to persistently high interest rates. But recent developments, including softer inflation data, and maybe an interest rate cutting cycle beginning as early as September have bolstered the case for investing in small caps. Now, these stocks are more sensitive to domestic economic changes and could benefit more immediately from lower interest rates. And really, the potential for increased M&A activity could also further enhance the attractiveness of these small caps. With valuations remaining relatively low compared to larger firms, small cap companies could become more attractive targets of acquisition by larger companies or even private equity firms looking to capitalize on their growth potential. And so this dynamic, coupled with broader economic indicators and policy shifts, suggests a potentially fruitful environment for small cap investors looking for value or even for growth. But it's important to keep in mind the reason why you get compensated more for small caps is because you take on more risk. I like to give the example that if Warren Buffett were to go out and ask for a bank loan, though he doesn't really need it, he would probably get a lower interest rate than I would. Because just as the bank is taking on more risk with me compared to Warren Buffett, you are taking on more risk for investing in small caps relative to large caps. And so the dynamics that are going on in the background, the macro environment, seems to me to be a situation where, going forward, investing in small caps could actually give you the risk compensation that's been lacking over the past couple of years. But we'll talk about more about that in the newsletter. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify, but be sure to rate and review, or even leave a question on iTunes. Also, go check out our InvestTalk YouTube channel where you can watch this podcast in video form. Just search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.